Hello and welcome to CMS Forex Daily Video Recap. I'm your fundamental market analyst, Nick Nassad. Today is Friday, September 3rd, 2010. Let's start with the main story from today, which was the U.S. jobs report for the month of August. Companies in the U.S. added more jobs than forecast, easing concerns that the economy was falling back into recession. Private payrolls that exclude government agencies climbed 67,000 when the forecast was for 40,000, after a revised 107,000 increase in July that was more than initially estimated. It had been originally estimated at 71,000 gain. Overall employment did fall by 54,000 for the second consecutive month, but we did see 114,000 temporary census workers let go following the end of the census. The unemployment rate, meanwhile, did rise to 9.6% as more people entered the labor force, which grew by 552,000. Manufacturing had a poor month, shedding 27,000 jobs, but construction added 19,000. Employment in healthcare increased by 28,000, and employment in temporary help services was up by 17,000. And this industry has added already 392,000 jobs since a recent employment low in September of 2009. Overall, the report should ease some concerns about a double-dip recession in the U.S., as it showed us that June and July weren't as bad as had been previously calculated, and August beat the low expectations economists had. Therefore, we saw stocks in the U.S. rally on the news, and it boosted the risk appetite in currency markets. But just as we had some new optimism after today's jobs report, we did have a weak ISM non-manufacturing report which followed it up. In it, the index, which measures the services industry, slid to 51.5 from 54.3, and that is the worst reading since January. That capped the gains in U.S. stocks. The ISM non-manufacturing report showed broad and deeper than expected slowing, with new orders at 52.4, down about 4 points, and the slowest month-to-month growth so far this year. Employment, which in this report includes government workers, is signaling contraction at 48.2 for a nearly 3-point decline for the worst reading since January. Still, if we look at currency markets, we did have a pretty classic risk appetite play, with risk on trades performing better, which means commodity currencies tied to global growth like the Australian dollar, Canadian dollar, and New Zealand dollar jumped, while safe haven currencies like the Japanese yen, the Swiss franc, and the US dollar weakened. Here we're looking at the US dollar, Canadian dollar, and we see the sharpest move following the non-farm payroll report, which came out during this red candle here. Back here on Wednesday, we had tested the 1.0660 level for the third time in the last 2 weeks, but it held as resistance, and with the tide turning towards risk appetite on the account of some better manufacturing data from the US and from China, as well as some better GDP data from Australia, we saw a bout of risk aversion on Wednesday. We consolidated in yesterday's session, and today, following the non-farm payroll report, we saw the Canadian dollar extend its gains, breaking out of the 8-session trading range we had seen. So we broke this support at 1.0470, and we hit a new low at below the 1.04 level in late New York trading. If we plot a Fibonacci retracement level of our move from 1.025 to 1.0660, we see that we passed the 50% level and even the 61.8% retracement level, which did hold as support for a little while in New York trading. Zooming this pair out a bit further, and drawing our Fibonacci retracement from the 1.01 level, we see that we are approaching the 50% retracement of this full upswing during the month of August in favor of the US dollar on the back of risk aversion. Now, this pair has been ranging throughout the past several months, so while we may not look for a target of 1.01, which would be the bottom area of the support for this ranging channel, we could look to test perhaps between the 61.8 and the 78.6% retracement levels. Switching now to the Australian dollar US dollar pair, here we saw a very strong gain on Wednesday and then consolidation yesterday, and following the non-farm payroll report, we were able to move past this high at 0.9115 and reach a new high at 0.9170 for the week. Zooming this pair out a bit, we next target the 0.9220 level, which was our high in August. So we're already close to targeting that level, and we had mentioned that possibility when we had last week broke above this downward sloping resistance trend line, and again on Wednesday as we had seen the very strong move in favor of the Australian dollar. Early next week we get the RBA interest rate decision, and while the bank is likely to hold rates steady, a switch of posture to a more hawkish tone will help this currency, and perhaps that is already being priced into the market this week. Taking a look at the euro dollar now, here too we had a very strong gain on Wednesday, and then we consolidated in yesterday's session, and today we saw the pair continue to move higher as we did have better risk appetite. Now, we had shown this upward sloping channel that we had established in last week's trading, but then we broke the support early on this week, but then we moved back into that channel in the second half of the week. And as we can see, this resistance, we're going to be coming up against resistance soon at 1.2920, which is also the horizontal level of resistance from this sideways channel we had in the middle of August. So we come close to testing that level, and we'll have to see what happens to the pair when we do so. So this area could act a bit as resistance, but if we continue the theme of risk appetite, then we could further retrace this slide we had in the earlier part of August with our ultimate resistance or target at above the 1.3250 area. In order for the pair to do so, we would need to see continued data showing stronger global growth and higher risk appetite should help this pair continue to go up. Until we see some very strong data from the US that shifts the feeling that the Fed will keep interest rates low for a long time, which is the current consensus, then the US dollar will continue to be used as a funding currency for carry trade, which means during times of risk appetite, it will fall to the higher yielders such as the euro, as well as commodity currencies like the Australian and Canadian dollars. Switching over to the pound-dollar pair, overnight the UK posted its latest in a string of weak reports this week as it showed its services sector activity cooling. That followed up weaker manufacturing, construction, and housing price data throughout the week. So while the pair did rally in today's trading following the dip in the wake of that services data, you could see that the gains were limited in today's trading, and we testing the 1.5450/60 area as resistance in this pair. This is an important level that has switched its role between support and resistance over the past 2 weeks, as you can see, and also in if we look back further a couple of months ago. Therefore, we shape up in this consolidation pattern where we have an upward sloping level of support, a horizontal level of resistance, or we can even look at this sort of downward sloping level of resistance that is the 200 period moving average right now. And so if we break this level come next week, that could be a positive sign for the pound, or this level could act as resistance. And if we seeing that the UK economy is the recovery will weaken with all this poor data, the pound may come under further pressure following the beginning of next week. We have sort of seen the pound drifting downward against the dollar, even as say currency like the euro dollar has rallied in the past 2 weeks. Now let's look at the dollar yen, and here the swing between risk appetite, between the non-farm payroll report and about a risk aversion as a result of the ISM non-manufacturing index was pretty evident. We have been in a sideways pattern most of this week, trading in a range, the last 3 sessions especially, and following the non-farm payroll report we see this pretty strong move higher, breaking the 200 period moving average and the 85 level, but just as quickly we turned back in the wake of the weaker ISM non-manufacturing index report, and we pretty much went back to the level we were at prior to the non-farm payroll report. So we look to end the week within the trading range we have seen over the last 4 sessions. We start next week with a national bank holiday in both Canada and the US, but overall next week is pretty light on US releases. We do have some important central bank decisions from Australia, Canada, and the UK, with Canada the bank expected to actually move and raise rates, as well as some employment figures from Australia and Canada, so those 2 countries and currencies have the most event risk coming up. Also on tap will be trade balance data from the US, Canada, and China, which should help to give a picture of global growth and trade activity. And that will wrap up the coverage of the Forex markets for this week. For more news, videos, and analysis, please visit our site, cmsfx.com. I want to thank you for watching and wish you all a great weekend.